You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. What a week. We had almost all of the mega cap companies announcing earnings this week. This is by far the biggest week of this quarter for earnings. We've had other numbers that have came in around. The earnings have been mixed. Google/Alphabet did fairly well after their earnings report, which was part of the reason why we decided to do a trade last week, a fear of missing out trade in Alphabet. The stock is down a little bit today, and I guess there's been some pressure that was created by Meta announcing earnings, or i.e. Facebook. And Google reacted very strongly to their, Google/Alphabet acted very strongly to their earnings report. It was up around $8 on the day yesterday, but we are actually trading fairly close to where it was prior to the split. After the split, stock came in right around 111, and we're still just kind of hanging there. So we get the run up, we get a pull back, then we get a little bit of a run up, and the bottom line, it just really comes down to chop in the marketplace. So let's start by going over the trade from last week. And the main reason why we did the trade last week in Google was that we looked at doing a long call spread going into the 20-for-1 stock split in Alphabet. And when we did that split, we had very expensive options, but we knew that they would become less expensive and we were going to get a lot of them. And that was the way to approach it when you're dealing with a very expensive underlying. So now that they've gone through the split, the trade that we looked at last week was just buying a longer term, deeper in the money call option, limiting our risk on the downside by buying that option contract, as opposed to buying 100 shares outright. We limited our risk to the downside on Google. Now, the stock has ran up since then. I guess you could have gotten out, but it was more of a longer term trade. But when we put the trade on last week, Google was trading at 113.90. And right now, even though we've had a run up, like I said, because of the way the earnings report turned out, we are now trading at 111.65. And I should mention that we are taping Options Playbook Radio on Thursday. The markets are open and they are rocking and rolling. So there's nothing that you'd really do on the Google trade. They announced their earnings. We went out further in time. We went deeper in the money and just looking for a movement in Alphabet going into the end of the year. And just stay the course. One thing I guess you could consider, though, and I'm just kind of coming up with this as we speak, is I'd maybe consider selling a shorter term call against it now. And that's mainly because the earnings report is done. I don't want to be short a call option going into earnings. And just because you're looking, you're expecting that big move in that underlying stock. So I would not want to be short a call option going into the earnings report, but now I would consider it and maybe sell a 30-day option contract. You could even go out 15 days on Google. You would be just fine. Okay, so now we're going to look at Amazon. On the stock play of the day on Tuesday, we looked at buying some protection in Amazon heading into their earnings announcement. And I've mentioned this many times on Options Playbook Radio that Amazon always likes to announce on a Thursday after the close, which means as option traders, it makes it interesting in that you have a volatile underlying that everybody is trading, and those option contracts have to expire in 1 day. So the July 29th expiration means that Amazon's going to announce earnings. Those options will trade for 1 day, and then all the time premium has to come out, and you by that expiration date. So I always like to look at something like a butterfly, something that wants a lot of time decay. So to start with, if we're going to be looking at this trade, and it definitely could be a very volatile trade, so we don't want to spend a lot of money on it because it's a 100% speculative trade. It's going to be a 1 day trade. In the past, when we've been a little bit more bullish, we've looked at some skip strike butterflies in Amazon, usually to the upside, and we would get the butterfly paid for. A skip strike butterfly just means that you embed a credit spread, a short spread, inside the butterfly to help pay for the actual butterfly. Now, you do it without kind of stealthily, without really knowing that that's exactly what's going on, but it adds additional risk. And in this environment, I don't want to add any additional risk. So I didn't even consider a skip strike butterfly this time around because the risk isn't worth getting the butterfly off for a net credit to the account. So I always like to have some fun with Amazon because of all those things that we mentioned. So we're going to be bearish today on the butterfly. The fact that Amazon right now going into their earnings is down a little bit. That's down $2.11. It's trading at 118.82. Now the markets are live, so I am just trying to take screenshots of these quotes overall. And we're going to go the expected move out of the money on the downside. So how do we get the expected move? Well, we go and we look at the long straddle of the most at-the-money option contracts. So right now, with the stock at 118.78, we're talking about the 119 call and put. It's trading right around $7. So $7.30 at the midpoint. But it's not an exact science, and all we're trying to do is figure out a strike. So I usually just kind of round it off, make it simple. So we're looking for something about $7 away to the downside. And we can actually get fairly wide on Amazon. Right now, that expected move is just on a percentage basis, just over 6%, which is pretty big. I think normally Amazon would be around a 5% expected move on earnings. So there is definitely a little bit more volatility in the marketplace, and rightfully so, considering what some of their comrades in the space have done. So here's the butterfly. We're obviously going to use the July 29th expiration. This is going to be a very speculative trade, but we're not going to put a lot of cash in it on a 1x2x1 basis. We're looking to pay around 75 cents or $75 for this trade. Now, I want to emphasize, not meant to be a recommendation on Options Playbook Radio. We just take conditions of the environment and try to come up with strategies that fit the conditions. And this is the perfect example of that. We're trading Amazon more so on the fact that they're announcing earnings on a Thursday and the options expire on Friday. That's the main reason why we're going to do a strategy like a butterfly, which needs time premium to come out of the option contracts if you are correct on your forecast. And if you're incorrect, oh well, you're going to manage your risk by literally limiting the dollar amount that you're willing to pay for that trade. Okay, so we're using puts. We're going to go down to the 110 strike. So right now, well, the stock moved a little bit, $8.50 out of the money. Expected move is $7.30. So we're going a little bit more than expected on the downside, but we're going to get a 10-point range that the underlying stock could trade in. Now, you want to be bullish on earnings? You just take the same concepts and go to the call side and go about that amount out of the money on the upside. So it's very simple to just flip this strategy if you want to be bullish on it. The strikes that we're going to use, we're going to be able to go 5 points wide. So we're going to be buying that July 29th 115 put, selling 2 of July 29th 110 puts, and then buying 1 of the July 29th 105 puts. So we're going 1 by 2 by 1. It's an entire unit. That entire unit, if you send it to the trading floor, the midpoint right now is 75 cents. It's a real tight market for the butterfly. The bid is 71 cents and the ask is 78 cents. So never a guarantee of a midpoint fill, but I would expect to trade somewhere near that level. But if not, the market isn't that wide. So you're getting really good markets on this strategy, considering we have 1 day for these option contracts to live. So our total risk, if we do the 1 by 2 by 1 butterfly, is 75 cents or $75 plus commission. The width of the butterfly is 5 points. So you take 5 minus 75 and you come up with $425 as your upside. But now that would take a miracle. You need to land right on 110 in order to get that maximum, and it will have to happen right next to the expiration. But the good news is that we basically have a 10-point landing area that Amazon could end up in this trade be profitable. Anywhere between 105.75 and 114 and a quarter. Basically anywhere between the strikes, 105 and 115. If Amazon does land in that range, there's a good chance that you're going to be profitable on this trade. So it's an inexpensive, and just to show you, and I think this is relative only because of the pricing of the 110 put. But if we were to buy the 110 put, that means we'd need it to move the expected move out of the money. If it moved less than that, the premium would dry up right away because implied volatility crunch and time decay that's going to happen really fast. And that's actually trading for 81 cents. So we're doing this butterfly. We don't get the benefit of stock going down 100, and we'd be really happy if we just bought the put outright. But to compare apples to apples, if we just bought the 110 put outright, it's trading for a little bit, just 6 cents more than what the actual butterfly is trading for. But it has a lot different dynamics. If we buy that 110 put, we needed to get to 110, and we needed to get to 110 in a hurry and then go beyond. In this situation, if we do the butterfly, we don't need it to. As a matter of fact, we'd be better that it got to 110 closer to the expiration date, the actual end of the trading day tomorrow. And so you just have a little bit more time to be right on that trade, even though it's only going to be a 1 day trade. You need time decay to work with you as opposed to buying that put outright and needing that move to happen very quickly. All right. So in summary, we're looking at a butterfly on Amazon, a speculative bearish trade. We are going to be buying the July 29th 115 put, selling 2 of the July 29th 110 puts, and then buying one of the July 29th 105 puts. We're doing this for a net debit of $75 or 75 cents to the account plus commission, and that will be our max risk. And that's it for this episode of Options Playbook Radio. If you'd like to learn more about what we do at Ally Invest, please check out my Twitter. My handle is simple. It's at my name, at Brian Overby. You can email me any questions at theoptionsguy@invest.ally.com. We'll see you same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.